Wake up, motherfucker.
All right, what's up? Sunday. Okay, the 12th. I wanted to do 2 streams yesterday, and I tried to reschedule it to do 2 streams today, but I guess not. Okay, let's see how far we're gonna get today with just one stream, okay? Markets open, oil is up, crude oil up 4%. I don't know. Something about the war, who knows if that matters. We have earnings. I only see like the Nasdaq down 0.3%. I don't think it really cares. Earnings really is all that really matters. Okay. And we'll see what the second day of trading on SK Hynix will be. We'll have to see what the Koreans will do overnight too, how that goes. Also, you have to remember that Kevin Warsh will be speaking with Congress. He'll have a testimony on 2 days in the morning, Tuesday and Wednesday, I believe. So he'll be there at the House and then the Senate, or is it the Senate first, then the House? Okay, doesn't matter. So he'll be there on 2 days in the morning before the market opens, yapping. And then when the market opens, he'll still be yapping, probably getting grilled by Congress about what? Who knows? Who knows if he's going to say anything interesting or anything new from what he's already been saying? He could just be like, blah, 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 blah. I've already told you what I told you. I'm not going to say nothing. I mean, it depends, right? He's kind of been doing this. I'm not going to be talking more than I have to kind of strategy so far. And we now know who's going to be in the task force. So I guess the most important thing will be these guys will be grilling him on the people he picked for the special task force. Okay, so we're gonna have to deal with that right now. I forgot to talk about that in the last stream because that was in the thumbnail. So I guess I'm gonna try to do this first right now. If otherwise, I might forget about it when I start yapping about other stuff. Okay, so let me see if I can find it again. All right. Something about do. Let us see. Man, it was like one of these tweets and maybe an article. One article. Not much of an article really, because there's not much to really talk about. But until he starts getting grilled in Congress. So let me see if it was this one. Okay, was it that one? Come on. And then I have to find the let's see, and I might have to talk about some wheat or grains, or do I have even time for peptides even? Or tokens? Let's see. And I have to start talking about the dark pool too. Oh man. All right, I gotta talk about that. Shoot. Let's see. Federal Reserve. Asha Sharma. Optics. See if I can find it again. Okay, let's see. All right, here it is. Good. Okay. Now, what was I looking for? Guess I gotta go through my history and find it. Okay, let's see. Fed. Awkward timing. All right. Okay, I can get this. All right. Okay, I got the two things. All right, let's go. Let's share the screen. Okay. Should be going. All right, should be going. Okay. All right. So let's look at this picture here. Press release. All right, let me zoom into this picture. All right, press release July 9th. All right, last week. Federal Reserve announces the leadership and objectives of its task forces to advance the conduct of monetary policy. So this is what they'll probably really ask him. Why did he pick these people? The Federal Reserve on Thursday announced the leadership and objectives of its task forces to advance the conduct of monetary policy. The Federal Reserve's commitment to price stability and maximum unemployment is unwavering, as is our resolve to pursue our mandate with rigor, said Chairman Kevin Warsh. The U.S. economy has changed significantly over the last generation, and never more so than right now. Each task force will carefully consider whether policymakers' means and methods, analytical tools, and policy approaches can be improved upon. I am honored that the best minds from a range of disciplines have agreed to work with us to sharpen our performance as an institution. The goal is straightforward: to ensure the Fed is best positioned to achieve our objectives in this consequential time. The five task forces will examine areas central to the broad conduct of monetary policy. They will be co-led by external advisors, accomplished economists, business leaders, and former central bank practitioners with deep expertise in their field, supported by Federal Reserve staff. They will cooperate independently with a mandate to follow the evidence, provide candid feedback, and produce rigorous findings for the FOMC, the Federal Open Market Committee. The leaders of the five task forces are communications, okay, balance sheet policy, data, productivity and jobs, and inflation frameworks. Okay, so you can take a screenshot and look at these names carefully if you care. All right. Maybe there's something else we can talk about from these people on the list. I see former president and CEO of Walmart, Doug McMillon. I see Mervyn King, former governor of the Bank of England. All right, that looks eye-popping right there. We have some professors of economics, all right, from both Harvard and the University of Chicago. Right there, data and balance sheet policy. What else? New York University professor of economics. Okay, Chairman. I think everyone has been staring at this thing right here, though. The productivity and jobs area. Assess the economic impact of new general purpose technologies, including artificial intelligence, to inform the Federal Reserve's policy judgments. Mark Anderson, co-founder and general partner of Anderson Horowitz. So this guy is pretty important. Okay. I don't know if we ever talked about him in particular on any of the shows, but maybe we should do a deep dive on this dude. But he's really a big deal in tech and AI. Okay. Charles I. Jones, professor of economics from Stanford University, currently on leave at Anthropic. And Asha Sharma, executive vice president and Xbox CEO of Microsoft. And this is the one that's really getting people pissed. The awkward timing of the Xbox CEO's new Federal Reserve gig. Which is worse, sailing your super yacht through the city where your company just made mass job cuts, or getting named to a U.S. Federal Reserve panel on jobs and productivity 3 days after announcing thousands of layoffs? It might not be a full zuck, but Microsoft Xbox CEO Asha Sharma is getting lots of attention, and not in a good way, for the latter this week. Sharma was named Thursday to co-lead a new Federal Reserve Productivity and Jobs Task Force, charged with assessing the economic impact of AI and other new technologies on the labor market. Her co-leaders, Mark Anderson, a venture capitalist and vocal AI booster, and Stanford economist Charles Jones, who is currently on leave at Anthropic, maker of the Claude AI chatbot. The gaming press, as you can imagine, is having a field day. The headline from Kotaku sums it up. Xbox CEO will advise Federal Reserve on jobs after mass layoffs. PC Gamer, for its part, noted that the task force is supposed to represent a commitment to price stability and maximum employment. However, that's the Fed's broad mandate, as described by Chairman Kevin Warsh. It's actually not the specific mission of the Productivity and Jobs Task Force, which is narrower, assessing what AI and other new technologies are doing to the economy. In a separate sign of backlash, Microsoft Communications Chief Frank Shaw took to X on Friday to knock down claims that the Xbox cuts were made to replace employees with foreign workers, calling it bad information, and noting that the H-1B visa figures being cited are company-wide renewals, not Xbox specific. He also pointed out that Sharma is an American-born, raised, and educated CEO from Wisconsin. Also lost in the coverage of the Fed appointment is the fact that Sharma is less than 5 months into the job, having taken over as Xbox CEO in February with a mandate to turn around and preserve the gaming division that spent more than $20 billion over 5 years while its core revenue shrank. The restructuring announced this week is a key part of that effort. What's more, it's hard to imagine that this is the timing Microsoft or Sharma wanted. Announcements like this are often outside the control of the participants. The Federal Reserve sets its own schedule. Still, it is tough timing for an executive who announced plans this week to cut 3,200 gaming jobs, about 1,600 immediately, with the rest over the coming year, amounting to roughly 20% of Xbox's workforce. Sharma herself called it the most significant restructuring in the division's history. Well, there you are. She's going to lead the Federal Reserve in what policies to set for the future as we enter a new world of AI and declining birth rates and mass immigration. So there we are. We are at a tipping point in the world's economy. Okay. Um, China is already 73 years in with the lowest birth rates of all time. So that's not going to be good. Japan's labor force is starting to shrink. From now on out, I don't believe any of their birth rates will improve to the point where they can actually fix that. So either they start immigrating more or they're going to rely more on AI and robots. Um, Japan is really all about making robots. So that's probably the strategy they'll try to take for a while, but probably mass immigration will begin shortly. Okay, so prepare for a new world if you haven't already. I'm pretty sure you guys seen how the world has been changing over the last 20 to 30 years since I've been mostly alive. Okay, so I've been through it. I've seen it. I've seen the trend. Uh, that's how you judge a good trend or a bad trend in the stock market. If you see a trend, it continues, and we are at the end of this trend right now. This is the final call for the big bull market, in my opinion. After that, we're going to be in a transition. Maybe that will last 5, 10, 20 years. I don't know how quickly they'll restructure the world's economies um, to a new growth paradigm. All right. But it won't be like the previous paradigm. The previous paradigm was driven mainly by overseas um, labor market outsourcing to Mexico, China, and Bangladesh, Indonesia, Malaysia, and a little bit in India, but mainly in like a lot of the large Southeast Asian countries and China. That's where it was. And plus South Korea. South Korea was at the upper echelon of outsourcing. And at this point, South Korea has now come out on top. It is the best performing foreign market so far from a year ago, right? They've won. They've won the battle in growth. China is kind of like wondering what it should do, right? They've captured a lot of that growth in the 90s, but they also don't want to be heavily tied to a US led world economy anymore, right? They want to be a competitor, and whether or not they'll absorb the leftover parts of Russia to try to bolster their need for resources, right? That's kind of their weakness. They need resources, just like in Japan in World War II, they don't have energy. China has to figure out how to get energy. They don't have oil. Um, what they're going to do is to do nuclear energy with thorium reactors. That's one way to get avoided. Otherwise, they're going to be relying on coal, which they're already fighting Australia about in the last 5 years. So that's another thing. Also, uranium, right? That they get also from Kazakhstan or wherever. So these are the things that we have to worry about. We're restructuring and reconfiguring the world, and Africa is like everyone's battleground right now with the metals like cobalt. All right. So, yes, this is what we're doing. This is where we're going. And I guess this working group is going to be important for us, okay? All right. So you got that. You got all this information. Okay. Let me see. Anything else I want to talk about before I want to switch over to the video right now? I want to try to get to this AI video, and I just want to get it to it quickly because we already been discussing this AI stuff. And let me get to this tweet here. I think this was interesting. See if I can find it. Let me see if I can find it. I got these two tweets to talk about. Okay, I got this one. All right. I think they'll be important. Okay, get to these. And then I don't want to get to that yet. Okay, and then I gotta find this other tweet. Okay, bear with me. Bear with me here. Okay. So this one was a tweet I gotta worry about. Don't need that anymore. Okay, let's see. Okay, let's see. All right, that's a good tweet to cover. And then we had some crap about tokens. All right, tokens. Okay. Let's see, 207 tokens. Zero hedge token. Oh. Okay. All right, let me see if this was it. All right. Tokens. Okay. All right, I'll find it. I guess it's not here. All right, let me see. Oh. Okay. All right. Okay, found it. Okay. Oh man, they could have like separated bookmarks for Twitter so that I could have like I could categorize the bookmarks, but it's just like when you bookmark it, it just goes into this huge bookmark section and it's just like, dude, bruh. like like dude, I make a lot of bookmarks every day now. It's like if I want to bookmark something, can I at least label it as a different category, like a tab? Holy shit, man. Like it's really annoying just to be going through and searching for everything. And the search for Twitter is pretty crappy, I've heard, and people have been complaining about it. They hired some new guy to improve the search feature of like fuck this. It's like I don't even get this. Like this all this social media, like Twitter's been around since what? 2005, 2006. You would think like they already like dealt with this. I rarely use Twitter until like the stupid 2020s or I mean 2016 when I was just using it to troll people. I mean that's why my stupid account here still has Eric Foreman with a black dude on it. I was just trolling conservatives with this black MAGA account, you know. Fuck, man. I didn't think I would take it seriously to use this, but yeah, Twitter is pretty serious when it comes to fintech. I mean, there used to be stock twits. Stock twits. I used to use stock twits for a little while, for a couple years, but Twitter after Elon bought it out, most people still use Twitter to talk about finance stuff. So, um, yeah, stock twits is really never competed well with it. It's like stock twits is its own world, and if you just want a broad set of opinions, you still have to go to Twitter. Like it's less biased over here. I guess that's kind of ironic. It's like most people think Twitter is more biased, but yeah, it's actually less biased when you look at it from a fintech. The stock twits pages with the stock tickers, they're usually it's just a bunch of like biased fanboys, like either people that hella want to short a stock or hella want to pump a stock. You're not gonna get unbiased information over there, like really. Okay. Anyhow, here we are. I'm paying $200 for $8,545.93 in usage. What the hell does that mean? So this is the tokenization here. Stock twits. It was a lot of pump and dumps when yeah, that's all it was. I found a few people I could follow over there for information, like actual legit information, like stuff that I wanted to that I didn't know about, but it was just mostly idiots that just went like, "Oh yeah, the stock is going up. Yeah, 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 yeah. Oh, the stock's going down. Hell yeah, hell yeah." It's like, dude, stop it. Like the nonsense noise started like becoming larger than the actual people giving real legit information uh and tips about like how you should trade and stuff. So after that, yeah, I stopped using it. So and then now that I'm using Twitter again, yeah, I might as well just just see if I can find some accounts that are actually useful because yeah, a lot of people went back to Twitter. That's what I heard like years ago. So I only used stock twits around like 2019, 2020, and 2021. After the last dump, like the big bubble, the big COVID bubble, it was like, yeah, it was just full of idiots after that. Saw a tweet. Historically, every 4 years, July ends with a major dump in. Yeah, yeah, that's true. I mean, I've said that before. I've seen many dumps start around July 10th. Like from July 10th onwards, it starts dumping, and that makes sense because it's the beginning of a new earnings season. So we're gonna get fresh earnings results, and that usually will mark a top if the earnings don't exceed fucking expectations, and expectations are very high from last quarter. All right, so I'm paying $200 for $8,000, $500 in usage. If you don't think the AI subsidization apocalypse is coming, you're mistaken. Okay. So I guess when he reads this, he's thinking that like, oh, I got a great deal. I paid $225 in quote unquote AI usage. So look at this like a utility bill, right? So you can look at this like a utility bill. This is my kilowatt hours, and I'm just paying this much for it. And over 30 days, it's like $8,500 worth of token costs. So I don't know what this means. Like, what is this crap? Uh, did he think he got a deal or something? Is that it? And then this Joshua Miller guy says, well, if this is for Anthropic, they're at roughly 100% margins for inference, which means you pay $200 for $100 worth of tokens that they marked up to 8,500%. So this number, this $8,500 is actually fake, and he really paid $200 for $100 worth of actual usage. Is that what it is? And then the guy responds, how do you know? And then he responds here, Dario, which is the CEO of Anthropic, has said as much, and it tracks the actual fundraising and investment rounds. They spend the margins and then some on training, of course. And of course, the API users are paying a lot, some of them. That's application programming interface. So if you don't know coding or what the hell that means, forget about it. All right. Okay. But that's the commodity cost. OpenAI may be different. Oh, whatever. That's wild if true. Could you point us to some sources regarding this topic? On the margin, I'm estimating. It's based on a toy example Dario gave to Dwakesh. Who the hell is Dwakesh? And I'm misremembering. He said north of 50% margins. Estimates seem to be around 60 to 70%, but that was before the XAI deal, which might be cutting into margins. Okay, and he linked this blog. I guess I'll have to read this. So I'm not in this. I'm not in this whole sector at all. I have no idea what the hell these people are talking about. And I played that NVIDIA token maxing video and some other stuff. It's hard to figure out what's real and what's not real in this world. Like, I guess you could say that these people could just be like hyping this stuff to the degree that nobody knows what's reality anymore at the investment side, right? If I'm investing in a company, Anthropic, which hasn't made an IPO yet, right? Everything's privated. You don't see what's going on in the company as a private company. So only until they IPO, which is either later this fall or early next year, you won't see the reality of it, because they only show you the reality or partial reality when they actually have to submit all these forms to the SEC as a public company. When you're a private company, you pretty much can do whatever you want as long as you just pay your taxes to the IRS. You don't have any shareholder coming in and looking at your stuff, all right? Or any analyst or banker or investment banker that has to go like, yo, we got clients that want to buy all these shares from you, but they don't know what the heck you're doing in the business. Can you explain this point and that point? As a private company, they don't really have to do that. You're a private investor. You might be able to get some, like, unless you have like a lot of money as a private investor, like, the CEO doesn't really have to tell you shit. you can get away with a lot more. So once this becomes IPO, this type of stuff here has to get cleared up, because if you look at this tweet like thread, it looks like these people don't even understand what exactly they just bought as a consumer. So does that mean I got a great deal? I bought $224 in quote unquote tokens, and and it should be like 8,500. Is that what is it? What is this crap? I don't even know. So whatever. whatever. But that's going to be a big deal for an investor. I'm not even a consumer of this. I'm not paying any subscription to any of this AI stuff. I have doubts about AI. I'm just using the free versions, okay? So I have no clue if this is actually useful to me or not as a business. I don't have a business. I don't know what I'm doing. So there you go. But this is the point. This is a sticking point we have to figure out. And there's going to be a lot more of these, okay? All right. What the heck was I trying to figure out here? Yeah, I don't know. Anyhow. Okay, so yeah, you can take a screenshot of this thread here. Okay, I'm gonna screenshot. There you go. Screenshot this. Okay, and down here. So we might, if we have time, sometime down the line, I'll read whatever this is. Dwarkesh. Who is Dwarkesh? I don't know. All right. So, but this Joshua Miller response here, yeah, you could take your screenshots here. All right. Now let's look at what Michael Burry was saying. Heisenberg, which is a famous Twitter guy on the fintech or finance Twitter area, he pointed out like the forward price to earnings ratio is really low. Yeah, look at that. Nvidia is so undervalued, which I mentioned before. Yeah, Nvidia is like historically undervalued, right? But the stock hasn't been performing very well. It's just been going sideways since late last year. Meta and Microsoft also was very low. Well, we've looked at Microsoft. Look at the software companies, right? They went up and then they went right back down to the bottom where they were in early April, late March. Micron, well, it's been dangling between 1,900 and 1,200 at the top. It's 6.49 for price to earnings. So that means you should keep buying it, right? Micron should catch up to all these other guys. Micron should be at least 2 to 3 times higher. So $3,000 a share in Micron. Well, Michael Burry says this. Now, class, repeat after me. I will never buy cyclicals at low PEs and record earnings. Say it again. I will never buy cyclicals at low PEs and record earnings. Okay. You have to remember what cyclicals are, right? I told you what cyclicals are. A cyclical company means that they move up and down based on a certain business cycle. Um, if you remember back when I made the examples of the 90s, what were the cyclicals in the 90s in tech? They were semiconductors. Semiconductors were not very popular stocks for that reason. They go up and they go down based on a cycle, a refresh cycle set by Microsoft and Intel. So the Microsoft Intel duopoly, as it was known, Apple was outside of it, right? Apple was outside of it. IBM got shafted. Okay, Microsoft won the war. They sold the software, which was more important than the IBM hardware. IBM thought they could sell hardware at an inflated cost, the PC, to you as the consumer. But Intel and Microsoft made a deal. Microsoft sold Windows, okay, to anybody that could make a IBM clone. So those were called the Clone Wars. You had Compaq, you had Dell, Hewlett Packard. They entered the Clone Wars. So they could sell IBM quote unquote PCs outside of the IBM ecosystem without getting sued because they cloned them. They cloned the idea of an IBM PC and they won in court and they couldn't get sued. So Microsoft sold any of the software. Windows 95 was the first big Windows upgrade. Okay. That's what killed Apple too. Apple thought they could win because they had a better GUI than Windows. Windows had Windows 3.1. Windows 3.1 sucked ass. Most people were using MS DOS and OS2 Warp, which was IBM. And so once we had Windows 95, that created the winner of the games Microsoft. That's how Microsoft really won the battle at the end of the day. So Windows 95. And from that point on, Windows and IBM Pentium chips were locked in a cycle. And every time you had a new Windows, it went with the next generation of Pentiums. And that's how you had the semiconductor refresh cycle, up and down, up and down, up and down. So most people didn't care about semiconductors for the long term. Every time you bought a semiconductor stock, you knew it went up for a few years and then it will go down in a few years. It will go up in a few years, it will go down in a few years. Micron was really one of those companies that still had that strong effect from a cycle, right? Micron, and any kind of RAM company is based on a cyclical matter. So Michael Burry says this, right? He says, like, dude, it doesn't matter about the AI. Eventually, these companies will go back to how they were before the AI hype made them go from cyclical to secular. Okay. That's the problem. So Nvidia, Micron, Intel, they'll go back to how they were, which means like a few years they go up, a few years they go down, a few years they go up, a few years they go down. So when I went into like the industry, the semiconductor industry, it was a good time, right? You had social media, you had smartphones, and that changed the game. Smartphones really changed the game because even though the smartphones had a refresh cycle by themselves, um, certain semiconductor companies that were heavily tied to Apple would only go up when you had a new iPhone. And then when you didn't have a new iPhone for a couple years, they started going down before like the next cycle would ramp up, preparing for the next iPhone generation, right? So you have to remember, Apple was the first one to have smartphones. It took a while before Samsung and Google to get its act together to compete with the Android and what. So and Nokia was on its way out. Ericsson used to make phones too. They're on their way out. BlackBerry. You remember BlackBerry? Yep, on their way out. So you had a news cycle based on iPhones. But eventually the social media, the Facebook, the Twitter, these things got people locked in to social media in a way that you had a news cycle based on the data center. All right. So that's where you started seeing like Cisco systems, Arista networks, all these what's the other one? Fuck, I forgot. Damn. Yeah, I forgot already the names. Like those buildings were right next to me too. I forgot the names. Well, whatever. I already forgot these names of these companies. Okay. You can look them up. Look up the data center type companies. And so you had to build semiconductors chips for the data center side. So it wasn't just the iPhone anymore. It was because so many people were using these iPhones to access services in the cloud, right? In the cloud. So iCloud or Amazon Web Services, right? So anybody that had cloud services and social media that they needed to have huge amounts of data and compute storage, all everything together in one place. That's what drove semiconductors from 2010 all the way up into 2020, right? Up into the COVID-19 crash. It should have ended there. It should have ended there. There would be no more growth. By that time, the only growth left was in China. China still had room to grow, but America was very advanced already. The saturation was already there. Everybody that wanted to use social media was already using social media. Netflix, they need like the bandwidth. YouTube, they need the bandwidth and the storage. Those guys were already maxing themselves out, right? Who uses YouTube and Twitter in China? China has their own Twitter and YouTube. They have Baidu, they have Bilibili. They don't need YouTube. So those companies, if they want to grow the semiconductors, that means you had to go to China and sell semiconductors in China. So that was where we are. And that's when I left the companies. That's when I left because Trump started fighting China and going like, we're not shipping you semiconductors unless you do this and that, unless you agree to these tariffs or this new trade deal. So once that started happening, it was over. We couldn't grow in China anymore. So any American semiconductor company that wanted to sell in China was stuck because that was the only way to grow semiconductors. And between 2020 and 2023 was the little gap period, right? AI wasn't around yet. ChatGPT was the first quote unquote AI company. And so only everything that's been happening from 2023 onwards has been because of the competition of ChatGPT, DeepSeek, Anthropic, Claude, Google, Gemini. So we're in a new cycle, a secular cycle based on that. So eventually we'll run out of things to grow, right? We've been lucky so far. We've been jumping from smartphones to data centers, right? And cloud, database, come out to AI. So what's the next thing after AI to grow these companies? That's what he's saying. He's saying like, once all this hype is gone, once everybody has AI already and there's nobody left to build more AI, this thing will go back to how it was back in the 90s. Like, who the hell needs to buy all these chips in the next cycle, right? Unless some aliens come down here and wants to buy chips to build their own data centers, there's no one left. Once every company on the globe has their own data center, once Saudi Arabia has its own data centers for AI, once India builds out all its data centers for AI, who's left, right? Once China, we can't even go to China. China has its own semiconductor industry because now the Chinese don't trust us anymore. They're like, if we use US chips, they'll cut us off whenever they want to. So everything now is separated into silos. The only way you're going to grow is to have each of these companies have their own little networks, right? That's the only growth path forward. Or you're going to assume that Africa, with its birth rate still expanding, is going to be the next place to increase your footprint. So pretty much only Africa. Everybody else has declining birth rates. So that's another thing we'll have to talk about. Shortly. I don't know how much time I blathered for how long now. Oh my god. Okay. Okay. Let's see how long we got. Okay, let's look at this. 12-month forward free cash flow. Oracle, Meta, Alphabet, Microsoft, and Amazon. So these are the top data center hyperscalers, I guess you want to call them now. They call them hyperscalers. I don't know why they call them hyperscalers, but all right, hyperscalers sounds fancy, right? Is that just a marketing term? I don't know. Okay, so these are the data center guys. These guys used to just do this just because they wanted to be part of the social media networking type of stuff. But now it's AI, and now they're spending all their free cash flow to expanding even more. If you build it, they will come. This is the mentality they have now. So before, they were happy to keep the cash to buy back their stock. That's another reason stocks would go up, because they would just buy back their stock. So even if you had no growth, you had so much money coming in because people were paying subscription fees for all these people. They would take that money and buy back their stock, reducing the number of stocks outside in the public so that the demand for these stocks would still be high, because the 401ks would keep buying these stocks. All right, your 401k is dumb. All it does is automatically buy, using your paycheck to buy shares of this stocks automatically in your 401k if you don't do anything, right? If everything is set to its default on your 401ks, they will just buy a bunch of Amazon, Microsoft, Alphabet, and Meta and Oracle without you knowing. If you don't actively manage your 401k, that's what it's going to do. And these guys will benefit from it. And so they take away all the shares with buybacks with their free cash flow. They'll issue shares to their employees as compensation, so they don't need to have high salaries after a certain point. If you're in tech, most of your compensation should be in shares. Okay, most of my money was not in the actual salary. At a certain point, I didn't want the salary because I would just have to pay higher California income tax. What I wanted were the shares. So those goofy little shares were worth nothing, but in 5, 10 years, and now, all the shares I held from the companies I used to work for before the AI, thanks to AI, they're up like 300, 400, 500, 600% thanks to this AI. So I am still compensated for my work that I did 5, 10, 15 years ago, right? Well, I didn't work 15 years ago, really. So I guess 5 to 10 years is as much as like I really worked. So that's how you get compensated in these companies. The people here don't actually want salary; they want stock. All right, and definitely these AI companies with the IPOs that are coming out, their stock before IPO is already worth in the billions, right? And the millions. So there's like multiple millionaires. Wasn't there like, yeah, there was a welder in Tesla, right? They keep hyping that guy. This guy's a welder in Tesla, but because he kept his shares in the stock, right? They paid him in stock. He kept those shares. He didn't sell them to someone else right away. He hoarded them, and he actually bought more whenever possible. So he took whatever salary he had to get more shares instead of actually um, getting compensated in cash. He made out as a millionaire once it IPO'd. Once SpaceX could IPO, there we are. So he's a millionaire. So that's how tech companies work. You want the shares. That's really the real compensation. It's not in the actual income, which you get a W 2 on. You don't like those W 2s, okay? W 2s suck. So that's another reason. All right. So this is important. Now the key free cash flow is going away from these benefits for these people. Like the free cash flow was used to pump up their stocks, and now it's not. Now it's being used to build out more data centers for AI. If you build it, they will come. Is that going to be true? Are the customers going to be there once these people stop building all this data centers? Once we hit a peak, it's like, okay, we maxed out everything we could do with all this cash flow to build as many data centers as possible. Can we make money by charging people tokens or subscription fees or whatever they want to do? That's a problem for another time, right? That's going to be a problem for another time. Okay, next. This is more the immediate problem we have now. So last quarter, we had actual earnings a lot higher than the estimated earnings, right? So this is the reason why all those semiconductor stocks really went sky high after all the earnings, right? So you had the benefit of the Iran war, which made people so bearish into the new quarter. By the time all the earnings started coming out, people who were still bearish because they were afraid Trump was going to do something, well, they got burnt. They got really burnt because all those shorts, all those puts helped fuel this huge rally we had. Okay, so the dark blue here versus the gray last quarter was a lot higher, okay, than what was expected. Okay, that's what people estimated to be expected, and it's like, oh, the real earnings was a lot better. Well, now the expectations has grown, right? The expectations, this gray line here at the end here is a lot higher than before, so that blue line better be a lot higher than that gray line. Otherwise, we're gonna go down, down, down into midterms. So that's where you would be afraid of a top. So get ready. Earnings season starts Tuesday with the banks. And then we will have ASML earnings on Wednesday morning, the first semiconductor earnings. Whatever they say might be really important Wednesday morning. All right. What's the next one here? The gap between S&P 500 trailing and forward PE is at one of its widest levels in history, usually only occurring at market extremes like the dot-com bubble and the 2022 bear market. Oh, so that's, yeah, well, we are at an extreme. So I think this previous chart already shows you that, yeah, we are quite extreme right here. The expected earnings, okay, better be better better chill out here, because the actual results uh based compared to the people's expectations, might turn this thing around. All right, so this is what we're gonna have to worry about. All right, so there you are. There you are. There you are. We are quite wide here. So the last time we were this wide was just before the 2022 bear market, right? This was during the great COVID QE pump and dump. Okay. And then before that was like what the dot-com bubble over here, I guess. So yeah, yeah. So there's gonna be a lot of bears coming out in the coming days. So if the ASML one doesn't meet these expectations, it doesn't give confidence to the people in semiconductors, you'll see a lot of bears come out and start going like told you so, or whatever. And if that happens, then you can trade, right? Then we can start trading, because this sideways garbage is like annoying as hell, because then we can't do nothing right now. Everything's just been going sideways. All right, guys. Hopefully you got that. I'm going to start playing the video here. Hyperscalers are check writers and chip makers are check cashers, roughly speaking. Correct. If you like buybacks, Apple is still doing billions of repurchases. I hate Apple stock. Apple stock is not good. I mean, my parents still have some Apple left, but Apple, buying from the .com up until like the 20s, that was about it. That was the main run. There's a lot better stocks you can buy right now than Apple. And Apple now is trying to sue OpenAI for stealing their their secrets or something. So either Apple with the new CEO tries to catch up with AI, or they're just gonna keep being put on the sidelines. Nvidia kind of looks decent buy on hourly and daily, at least for a swing. Yeah, maybe. I don't know. I think there's better stuff out there, really, compared to Nvidia. You can get a lot more action in biotechs, or because if biotechs keep going down next week, you can buy that at a better discount than Nvidia. Did you buy any tech companies in 2022? No, I just bought the S&P 500 again and the Nasdaq 100. Like I said, I'm a mature investor now. I'm too old to care about individual companies. I just buy the ETFs. So I just look for like the market top, right? And then just get out and then come back in once we have a market bottom and do it again. So I rarely look at individual tickers unless it's something really interesting to me, right? Something really interesting. Otherwise, I just avoid it. I just stick to ETFs and leverage ETFs. That's just how it goes for me. And that way I don't need to do a lot of homework either. So yeah, I'm lazy now. Okay, powered by AI. AI needs a lot of chips. Robotics. Yeah, robotics could be something that's coming up next. BB stock is doing very well now. Yeah, I noticed. Yeah, Nokia is doing well now too. I mentioned Nokia as well. Nokia and BlackBerry are doing very well. But we have to wait for an actual bottom in October before I recommend any of those to guys, because those things are just following the rest of the tech companies. And Nokia is just a European one, so they have their own peculiarities. I think a lot of people they got tired of staying in U.S. tech companies. It's over concentrated. They started looking for other tech companies in Europe, um, and South Korea and Japan. Tech companies are probably too scary for a lot of people. Okay, Apple suits Samsung. Don't even remember what happened. I don't know. Yeah, I don't even remember. I'm pretty sure. Yeah, there was a lot of lawsuits going back and forth between a lot of people. I don't remember most of them now. Let's see. I bought Meta in 2-3 weeks ago. Okay, okay. Let's see. Yeah, the XLC sector is improving. That's true. So I mentioned that already. Use my favorite stock. I might have to pay for Claude to have it program something for me. Yeah, I mean Claude is the best one, right, for programming. That's what I've heard. I'm not sure if that's true anymore though. Okay, let me get that. All right, let's see what else. Anything? Okay, good. I got through it. Okay. Timing the market beats timing the market. Well, not for me. Timing the market is a lot better for me nowadays. Now that I learned everything. I mean, I've told you how to time the market already. I've told you already my secret weapons here. Like the margin one is my favorite. I actually tweeted that today. Another guy was talking about some way to time the market, and I tweeted him this. I said like, well, you can look at margin debt as a way to time the market. That's a way that can time the market. There's lots of ways. I found a lot of ways during my time already. It's pretty simple to time the market. A lot of boomers have their tactics, and they work. They still work. They're in the know. Let's see. No, it's not this one. I don't think it's this one. Actually, I do have to talk about this, but it's not this tweet. No, no, no. It's not this one. Okay, let's see if I got something else. Was it this one? I don't know. Okay, I think we're done with that. Let's see. Okay, I'm done with that. I don't need this anymore. All right, we talked about this already. All right, good. Okay, so maybe it was this one. Was it this one I tweeted today? Okay, we already talked about this. We already talked about the VIX and the whole thing. Yeah, maybe I'll talk about this again. This is short term. This is not something long term though. Okay. Anywho, all right. So let me see. It was a recent tweet I just did right now, just before I came on. Let me see. I should be able to find it pretty quickly over here. And then we're going to talk about the dark pool. But first, I need to get through this stupid video. Let me see how much time we got left. Okay, I still got time. I just want to get through that because that Canadian talk's really slow. So I don't know how far I'll get to the demographics, the AI with demographics, labor market, because I want to get through that. That really is important. Definitely important before Kevin Walsh starts speaking to Congress and he gets grilled by these guys. I'm sure they're going to bring it up. Why did you hire that Xbox CEO? Why did you hire her? She laid off 3,000 people. Do you think she knows how to save jobs of Americans and blah blah blah? You know they're going to do that. It's political theater. Every time it doesn't matter. They don't care what you say. The Federal Reserve is independent of you, the politicians. Once you get them appointed to being Fed chair and whatever, they can do whatever the hell they want. So it's all just political theater. The senators and representatives just want to look like they're against the man. Yeah, look at me. I'm fighting the man on your behalf. I'm grilling this guy. See, I'm talking about this evil Xbox CEO laying off all these Americans, right? So that's what they're gonna do. I know it. Come on, I've been there, done that. That's why politics is such BS. It's just WWE nonsense to me, honestly. So that's why I never took politics very seriously. Everything is all about the actual the private sector and how they influence the lobbyists and how they influence actual, actual local elections and things like that, because the local elections from the United States is really fascinating in that sense. It's like it's not something that you can control top down, because the United States is all about decentralization. So if you want to influence the United States, you have to go from bottom up. Everything is about bottom up. You look at like all the local politicians become megastars in the federal level, right? So you grow a Obama in like the Chicago Democratic machine. You grow a Newsom from the San Francisco LA Democratic machine. You grow like, so all these people are grown from the local level to be the next like appointed emperor or whatever, right? That's why Trump was so annoying to a lot of people, because they're like, what the fuck? This guy is not from a political like, incubator. This guy just came out of nowhere, just threw his money around and forced his way in. So that annoyed a lot of people, right? That really annoyed a lot of people. Okay, here we are. Here we go. I found it. Okay, I'm gonna discuss this, and then we'll move from there. Okay, hopefully you see this. Okay. Come on, load it up. Okay, so this guy tweeted this long tweet here. This is all you need to do to time the stock market. Okay, screenshot this, save this. Okay, the put to call ratio tells you when everyone is panicking and when everyone is too comfortable. Every single time the put to call ratio spiked above 1 since 2000, it marked a generational buying opportunity. .com bottom, GFC bottom, COVID bottom, tariff crash. Every single time it collapsed below 0.7, a pullback followed. Pre-GFC top, pre-COVID top, 2022, pre-tariff top. Right now, the put to call ratio just hit 0.61, the lowest since December 2020. That means option traders are the most bullish they've been in nearly 6 years. Okay. Maybe we'll get back to this some other time, but Tom Bowley, I played his videos a few times from before. He likes to use like the put to call ratio methodology of timing certain things. Okay. So he uses a moving average of the put to call ratio. And if it gets below a certain level, it's too bullish. If it gets at a certain level, it's too bearish, whatever, right? So it's not a perfect indicator, though. It's not that perfect. This guy makes it sound like, oh, it's easy. Oh, yeah, once I see this, I know it's the bottom or I know it's the top, blah, blah, blah. Yeah, okay, dude. No, it's not that perfect. So you read the caveat down here. Does it mean you sell everything? No, but it means that this is the time to stay balanced, not all in one sector. The best buying opportunities will come. Stay patient. When everyone is greedy, be cautious. When everyone is fearful, be aggressive. So all this means is like, what would you do? You would, well, okay, maybe I would sell some of my stocks and buy more bonds or something. Is that all you mean? So it's not going to be a perfect timing, which is what it is. The tweet is like very sensational, right? It makes it sound like, oh, this is so easy. You could time it perfect at the absolute perfection. No, all this means is like, well, maybe you shouldn't be so aggressive anymore. We're reaching an area where you should start thinking about being more in bonds or some other safe haven, right? Sector instead of being in equities. That's all you would use it for, really. Okay, well, I have a better one. All right, so that's why I said like this. Well, how about this? Why don't you try the FINRA margin debt rate of change? So you would take the margin debt and you would get the rate of change, and then you would do it. So I've already covered this already. You take it when you sell, okay, when the 15-month rate of change falls below 48%. So when people stop using leverage, stop borrowing money to buy stocks, and it starts slowing down in growth, then you know it's a top. So the last time this signaled was in 2021 in November, which was perfect. That was the actual top, you know. It didn't hit that top again until 2023. When you do it for the bottoming, it's not very good. The bottoming, it's too slow. You can find another signal to get the bottom. But if you did use this thing to get a bottom, then you would buy it when the 15-month rate of change is around above negative 21%. Okay, so this is a slow moving signal because it's only updated every month or so, and it's delayed by several weeks because the FINRA data that they give you is delayed. I'm sure if you worked at a big bank, you would get this data synthetically and more accurately and in a quicker time frame than in the public. But even with the public information given to Joe Schmo, this is perfect timing, right? This times it pretty well. So there's very few false signals, very few right here. And those few false signals probably can be corrected with other signals. This is just one signal. You just use this signal on top of the other signals that you have and make a table. And you could say, like, if all these criteria hit, then I know I'm at a top, right? There's other ones too that we've discussed before, like the discretionary to staples ratio signal, or what was the other one? The McClellan oscillator signal that I created. So there's other ones that I have on my arsenal. I'm not using just one, right? But the put to call ratio one is another way to use a signal. It's not a very good signal though, because it's not very perfect. It's very noisy. You probably should be using a moving average, but even then, it's not going to be very accurate, because even this signal hit today, or whatever. When did this guy say it hit? Was probably Friday or something, I'm guessing. Well, do you sell everything now? No, probably not. This thing could still go up another year before you actually hit a real top, right? It takes a while. It could take a while, or many months, you know. Like like this thing, he circles this at the COVID top, but bro, it was hitting that signal probably around October in 2029, all the way into February before the COVID drop. So when exactly would be the time you should sell? No, this thing won't give it to you. It just tells you the conditions look bad, but that bad condition could last many months to a year, or maybe even 2 years if it's crazy enough. So this is not a very good signal, honestly, this put to call ratio thing, but it is something that people use for sure. Yeah, I've seen it. People use it all the time, but I don't like it because it's not very perfect. I think you could find better ones out there. All right, but yeah, if you're a boomer and you have nothing to go on, this is a signal that's very popular to them. Okay. All right, that's it. Let me get to the video now. Let's get to the video. Let's get to the AI crap, Ola with demographics, birth rates, and all that. That's how we want to do. Let's prepare for the impending Kevin Warsh grilling. Okay. All right, let me find it. I have so many things downloaded now. Oh my god. Where is it? Oh, this folder, that folder, this folder, this folder, that folder. Okay, here we are. I think about 16 minutes into this. Okay, somewhere around here. Yep, he's going to start reading this paper. All right. All right.
And we're going to
just try to drink some coffee or energy drinks when he starts talking about this.
And we're going to see if we can beat up a narrative and financial services. And we're going to.
Damn. This thing doesn't give me a more accurate way of.
And we're going to see if we can beat up a narrative and financial services zero. All right, there's been a lot of talk about this paper. A new look at AI's impact on jobs. Firm-level AI spending and workforce adjustment by Ramp and Revelio. And they find that companies that adopt AI tend to grow the fastest. Whenever you're looking at a paper like this, what you want to do is immediately go to the methodology section and have a look at the methodology section, because whenever we're looking at an issue like this, where it looks like you're looking at correlation, you want to make sure that it's not just correlation, that there is some causation in here, which means you need to observe, have observations over a period of time to see which variable came first. To say fast growing companies, or those that adopt AI, tend to hire more. You have to figure out, well, are you hiring people and then they're using AI, or are they using AI and then you're hiring someone, because you need the causal factor in there. The second thing you look for is a control group. I'm leading with this because the data I'm going to show you shortly has some of the effect of that control group in there. You have to find a control group. Now, they do claim to have a control group, and I read the methodology very quickly to figure out where their control group is. And their control group is within the same time window that they're looking at. They're looking at those that adopted AI and what was their hiring plans versus those that didn't adopt AI, but that did later on. and over that period of time. Wrong control group. You have to go to a period of time in which there was no AI and have a look at hiring. So let's say you go to 2015 and you run the same data set. You find the same data set, except you're not going to have an AI intensity. You just grab a data set and say, okay, what were the hiring plans over 2 years of companies that had the same characteristics of these companies, venture-backed, engineering. They do talk about the types of firms that tended to. Where are we here? High intensity adopters. They do explain what these high intensity adopters are. Larger, more technical, faster growing firms. So you think, well, if that was a 2015 firm, would they have increased their headcount over 2 years anyways, even without AI? That's your control group. Is you have to go back to 2015 because this was over a 2-year period. You know, what was their hiring plans 2 years later? They found it was 10.2. By the way, 10.2 is not a lot. That's like saying 2 years ago I had 20 employees, today I have 22. That's not a lot. In fact, you would say, that's it? Yeah, I use AI. I only needed to hire 2. But you have to go back to 2015 and say, well, over a 2-year period, the firms that shared these same characteristics, what did they grow by? You might find that, well, they grew headcount 30%. And then you get to this set and they grew headcount by 10%. You would say, but that's much lower than the control group without AI, not the control group in a window in which AI existed anyways. So I read the methodology quickly, but that sort of jumped out at me as a big mistake. The other issue is, what about survivorship bias? You're just taking the winners. What about all the companies that didn't make it? Shouldn't you count all of that in there as well? Right? So if you say, if you just took lottery winners without counting all the lottery losers, you'd get the very real idea that everyone's winning the lottery, right? So you can't just take the winners. The winners would have grown their head count anyways. So you're putting a lot of, I think, methodological, I can say it, methodological error into this. And again, in their defense, I have not read carefully the methodology section, but from what I can see, the very things that I would expect to see would be missing. All right, that brings me to this. This is information, the BLS category for information jobs and for healthcare jobs. And within here are a bunch of classifications that would also include coding, software, data center, all of that. And it's for 10-year periods, 2016 up to 2026. And this is the month that we're in right here. So if we go backwards, we find a peak in jobs in 2022, 3,076,000. Look at 2016, 2.8 million. You had an increase into 2017. It increased into 2018, increased into 2019. Then you had the pandemic. So you had a decrease, and then you had that ramp up during the pandemic or the period of time after the pandemic where everyone was hiring IT, peaked at 3,115,000 jobs, and then started to let those people go. And if we think that all that was going on, because we have heard this narrative, is that the companies that are cutting IT jobs that are blaming AI are really just AI washing. All they're doing is correcting for the hiring they had during the pandemic. You would expect them to settle out at the growth rate that we observed pre-pandemic, 2016 to 2019. Can we say that the world today versus 2019 is far more compute intensive than it was in 2019? Would we say the IT sector is far more important today than it was in 2019? I think we can, which means we should have higher jobs than the 2019 base level. We're below that. In fact, the level of jobs in 2026, 2,774,000 is below the 2016 level. For a world that appears, at least in North America, at least the US here, this is US data, that appears to have gotten more coding intensive, you have fewer jobs. Year over year, it was a drop of 3.1% in the headcount, 0% compounded annual growth rate over the 10-year period, because 2.8, 2.774, I have a negative sign in front of the zero because it's 0.0 something percent decrease, but no growth over that period of time. And the headcount here is lower than 2016. So you have more than pandemic hiring correction going on here. This is non-seasonally adjusted data down here. Year over year, this is actual count, non-seasonally adjusted, so we can use actual head count here, or statistically accurate. Let's just say that. It's not the exact head count, it's statistically accurate without any seasonal adjustment. Year over year, 91,000 positions gone, 22,000 positions gone over 10 years. Just since 2023, 257,000 are gone. Now, some of that is the result of pandemic overhiring, but you figure you'd return to a base of 2019 level with some growth off of that. Not only did you remove the pandemic level hiring, but you went all the way past 2016 and lowered headcount before that date. So I think that needs some explanation. Which is why I started with that paper that suggested that companies that are adopting AI tend to hire faster. You cannot say that unless you have a control group from outside that period of time. And these jobs are saying, well, no, there's zero growth over that period of time. In fact, headcount is actually lower. Look at healthcare. Healthcare tells a different story. Year over year, 2.7% versus negative 3.1, it's 2.7. And if you take 2016 all the way to where we are now, that's a 2.3% compounded annual growth rate over that 10-year period. If we look at non-seasonally adjusted, the statistical head count without any seasonal adjustment over that period of time, 4.8 million jobs over 10 years. 622,000 over the last 12 months, 2.4 million over the last 3 years versus 3.1 for all jobs. This has been a healthcare economy for some time. We're going to have a look at the demographics here shortly, and that will help explain the drop in the participation rate and the rise of healthcare spending. All right, this is a world population pyramid site. The website is populationpyramids.org. A lot of really good information. This is 1950 total population. This is global population, 2.4 billion. Median age 23.59. And if we just drag the bottom line across by the years, you can see that pyramid expanding. All right, we'll just keep dragging that across. And look at the median age. By the time we get to 2008, 28.44. Let's keep going. Look at the bottom of the base. Right, it's stopping to be a pyramid, and it's more like a block at the bottom. And you can see the median age at the top is now 32.31, 8.19 billion. But you can see the different cohorts here, and especially at the very top. If we go back to 1950, for example, you had very few people in the 85 to 89 range. By the time we get to 2025, this is the 85 to 89 range. You can see significantly more people, and we're pushing up into the 95 to 99 and the 100 plus range. So people are living longer. But look at the bottom of the pyramid down here. See how the birth rate here is lower than the generation before it. Whereas if we go back to, let's just see if we can drag this back. I have an ad that's in the way here, sorry. Let's drag it back here, all the way up to about, right there, to about 1994, you had this kind of shape around the globe. Let's have a look, closer look at the United States. Let's type in the U, click over here, and there is the pyramid we can see the average age here is 39.5. 39.5, whereas the globe was around 32, so it's a much older population. And pyramid type constrictive, and DTM stage 4. If we click on this, it'll tell you what a stage 4 demographic transition is. Low stationary phase represents population stability in developed nations. During this stage, both birth rates and death rates are low and approximately equal, resulting in zero or minimal population growth. So if you don't have any population growth, if you have the same population and you keep the same participation rate, you don't need to increase any jobs in the economy for the same participation rate with zero growth in the population. In fact, if you had slightly negative growth in the population, keeping the same participation rate, you would have job losses. Those job losses are not a sign of economy that's weak. It's a sign of the demographics of the economy. So perhaps the job market over the years has evolved to reflect not the strength of the economy, but the aging of the population. Population structure typically shows a rectangular or columnar shape, indicating balanced age distribution with site population aging. Low birth rates, low death rates. When I say low birth rates, at or near replacement level, low death rates, advanced healthcare systems, zero population growth, rectangular population structure, high life expectancy, 75 to 85 years, established aging population, but manageable dependency ratios. Countries with stage 4, Germany, look how bad that is going to be for Germany. Australia, Canada's in here as well. Look at this bottom of the pyramid here. When you hear people saying we're not having enough children on the planet, we're not creating enough population, that's what they're pointing to. Is give it a generation, the top of the pyramid disappears. This big part of the pyramid disappears. And if you keep going with this, the bottom part of the pyramid is smaller than the top part of the pyramid that is leaving, which means that the world population will begin to shrink. And if world populations begin to shrink, GDP, global GDP will begin to shrink as well, or at least show zero growth, because you'll create more GDP with 20 people than you will with 10 people. GDPs will shrink. There'll be job, if you watch the labor market, you'll say this economy is shedding jobs, but it's not the economy, or should I say it a different way? Maybe it's not the economy shedding jobs, maybe it's the demographics shedding jobs, and that the job numbers we're looking at are not comparable to job numbers we would expect to see some 20 years ago. That could explain why macro hasn't really been working very well, is because I'm looking at the economy and looking at the numbers saying this is a measure of the health of the economy, as opposed to saying this is a reflection of the demographics of the population. Let's have a look at the US a little closer and see if we can look at this participation rate and say, well, that all sort of makes sense. Blue line, black line, that is the working age population. The working age population, the participation rate is 61.5%. So the count within here are the number of people. Multiply that by 0.615, that is who is in the labor force. Multiply that, subtract out those who are employed, you get the unemployed. And if you divide the unemployed by the labor force, you get the unemployment rate. If we look at different cohorts, we have 61.5% participation rate, which is way over here. This is labor force participation rate, 61.5%. You have to go back to March of 1976 to get a participation rate that low at 61.3%. 50 years to get a participation rate that low. So when you start hearing about, the productive economy over the last 3 years have been adding about 19,000 jobs per month once you control for healthcare. And out of that 19, I haven't even controlled for government. And the participation rate has been dropping for the last little while and has been dropping significantly just in the last year alone. We're at 61.5. You got to go back 50 years. blindfold some economists without context, without the demographics, and they would say that sounds like an economy that is under pressure. What's going on? Well, people are aging out of the workforce, that's all. 16 to 19, participation rate is 41.6%. That is participating in the labor force so out of every 100 people who are 16 to 19, 42 are looking for work, and then you have an unemployment rate there, let's say it's 10%. That means there's about 4 to 5 who do not have a job but are looking for work. When you get to 20 to 24, the economic reality of existence shows up. 70.6% participation. 25 to 54, this is serious stuff now. 83.3% participation. Of those that are aged 25 to 54, you either work or you're on the street, right? Look at the 55 plus, drops to 37.1. Pre-pandemic, that was in the 40s. If you look at the labor force participation chart, and it does break down per age group, this is where I got these. If you look at that chart, and this is the pandemic, you had a participation rate that did this and it dropped, and it's just still dropping. It never recovered. Whereas the others, they dropped, and you can see that it recovered, and now it's rolling over, but it is this cohort over here with the low participation rate. But look at the size of that cohort. This long bar over here is what has retired since 2020, because this is 2025, so in 2020 they would have been down here. They have retired. Look at the generation behind them. I shouldn't say the generation. The 5-year gap group behind them is larger than them. So over the next 5 years, they'll be retiring as well. But look at over the next 5 years what will be coming in. This group over here. This group will be leaving. This group will be entering. So we would expect that the working age population, the labor force, is going to shrink over the next 5 years. Who's leaving? This cohort over here, 21,537 that are aged 60 to 64 will be leaving the working age population over the next 5 years. What's coming in? 21,061,000 that are aged 10 to 14 will be entering the working age population over the next 5 years, because the 14s will be 19s, and we have the 16 to 19 group. Now this is 10 to 14, so these will be 15, because this doesn't break down based on BLS, but it's a rough estimate. The conclusion is, over the next 5 years, the population without immigration now, just with its where we are right now, the population coming in will be slightly smaller than the population that is leaving. So that the labor force is expected to shrink over the next 5 years if the U.S.'s immigration policies and birth rates stay where they are now, which means a zero growth population country. So we would expect that these numbers would reflect 15 years ago an economy under stress. Over the next 5 years, they will represent a demography that is getting older. Well, if you're getting older, then you got Medicare, Medicaid, which is already under stress. More people drawing on their Social Security, which is already under stress. So government spending on entitlements is set to increase. And those that are paying into the system to fund these that are leaving the system are going to be smaller than the ones that are leaving. So government finances in the U.S. are going to hit a wall unless you redefine your entitlements. But this has been the problem, I think, over the last 5 years of looking at the economic data and saying macro is not working, because the economic data is probably catching a lot of the changing in demographics, which means the signals that would have worked 20 years ago don't really work today.
All right. So we went through a long, circuitous path to finally reach the conclusion that if you looked at labor data, labor statistics, like people used to do in the 70s, the 80s, the 90s, early aughts, It's like they would say like, "Yo, there's a recession coming in. Yo, there's a recession." Well, it won't work anymore, right? So a lot of people were thinking there were going to be a recession sometime during 2023 to 2024, like the crazy bubble pop that we had into 2022. Like the ramifications were going to catch up, and eventually in 2023 and 2024 we were going to have a recession, and that did not happen, right? You remember when Trump was going at Biden, he was the GOP was talking about like, well, technically we had a recession in 2023. We had back-to-back GDP decreases. We had like 2 quarters of a decrease or in GDP growth. That's a recession technically, or something like that. I don't know. They were doing the strict definition of a recession, right? And they were like using that against Biden and the Democrats, and that was pretty funny. But we didn't really feel any kind of real recession, right? Yeah, technically it was a recession because the letter of the definition, the letter of the law, the definition based on its core specifics said that if you had a GDP that shrank, you were in a recession. But nobody in Main Street really felt anything, really, right? Inflation was still high from the stupid little QE COVID bubble and the lockdowns and all the crazy stuff that happened from that. And all right, yeah, people were kind of not like feeling too comfortable like they did, but still they weren't uncomfortable. All right. They weren't being pressed like they are now. Inflation right now is starting to go back up. Coffee prices are going back up. Ground beef prices are going back up. So now it's getting worse, right? We're kind of like feeling a lot of troubles now. But in any case, the whole point is that like we can't be using these metrics to say that there's going to be a recession. There's going to be a problem. The labor market is shrinking. That's one problem. The other problem is that like the entitlements, like he said, Social Security, Medicare, Medicaid, who's paying for that coming in the next generation? That's going to be a problem, but probably not an immediate problem right now like Social Security is. I mean, I've heard like some estimates saying Social Security will run out in a few years. But the real thing is that the numbers are being distorted by the fact that we have an abnormal shrinking demographic, which we haven't had until now, right? Low birth rates, and we're trying to pad it up with immigration, I guess. And if immigration policies are kind of being looked at a little bit differently, and it's like you just can't mass flood the whole country with people just to pad up this issue here with entitlements. That's not going to really fix that, I don't think, because if there are not going to be any jobs for these people, why are you shipping them here anyway, right? And that's why we're trying to decide, okay, we're going to grow more semiconductor factories, drone factories in Ohio, Illinois, Indiana, Arizona, Texas, and we got data centers being built in Utah, Virginia, Maryland, right? So we have all these things that's in question. And so what are the congressmen and women going to ask Kevin Warsh and the damn task force, right? You have all these task force now. Are these like the smartest people on earth trying to decide how to get around these issues that are coming up in the next 5 to 20 to 30 years? That's what you have to wonder. All right. If you trust them, if you trust these elite groups of economists and tech moguls how to run a new economy based on tech, then you don't have to worry. Just buy the S&P 500. It's going to keep going up. If you don't believe them, if you think these guys are going to be morons, they don't know what they're doing, they're going to make a mistake, once we enter this transition period in the old economy to the new economy, then we will crash and burn at some point before we have to fix it the hard way, which is basically reset the economy through an epic recession, right? Or epic depression. I don't know what's going to be. People are always going to be worried that another 2007, 2008 financial crisis is around the corner, right? A real estate bubble or some other bubble, who knows, right? The AI bubble might be the catalyst for all these things. So, yeah, that's what we're going up against. So it's going to be hard. It's going to be very hard to tell, right? very hard to tell, like, well, is the economy healthy or not? Because the labor market looks kind of weird.
So it could be that you can have a healthy job market in the US with very low job growth each month simply because the labor force itself is shrinking. So it is the unemployment rate at 4.2%. However we get to it is the only one I think that really matters. I know, it's back. I took this away last week saying, I don't think we need this anymore. And a bunch of comments were saying, hey, we do need.
All right, so I'm going to skip ahead of this. He's going to talk about interest rates again. Oh, man, who cares? Honestly, interest rates don't really matter right now. So I think he's going to talk about the task force here. Then he started talking about something else.
11, when I was leaving the Fed through now.
Yeah, I might not be able to get it to today, but I think we got through everything I needed for the AI. Okay, he's going to talk about tokens right here. This is good.
Now it's screw you.
Okay,
you're not going to.
This is good
plan.
All right, I'm going to get through like maybe a few more minutes of this, okay, to kind of prepare you for what I want to talk about with tokens. The token costs. This will also affect how we look at the economy, right? If AI is going to be a replacement engine for the next growth phase of the US, then yeah, we have to look at how it affects like the consumer and the labor market in turn, right? How's it going to affect inflation? That's going to be really important.
Raise the nod if this does not. So there we are. Mortgage, 6.43%. Mortgage apps for June, the week ending June 28th, flat, nothing. And home price index, April, month over month, negative 0.1. Case-Shiller is up 1%. Okay, let's spend some time on AI and AI plans. These are screenshots. Here is my Claude. You see I have the max plan. It's 5x. I pay 140 US dollars a month. I say it US because I'm not in the US. There it is right here, Fable 5 included until July 7th. I thought, why? Why only till July 7th? I better hurry up and get some stuff done. You can use up to 50% of your weekly limits on Fable 5. Then it runs on usage credits. It's not included in your plan. Oh, it's included for now as a puppy dog sale. It's here, why don't you take care of this dog for a week? And then we're going to come and take it away. So how much does it cost? $10 for every 1 million input tokens, $50 for every 1 million output tokens. Here's a screenshot on my usage. You can see I have the 5x current session. They're 5-hour sessions, 3% used. All models, resets in 12 hours and 16. You can see I got 10% used. Fable resets in 12 hours, 14% used. What did I get here? 21 prompts. I did a document review and an edit. The document is about 50 pages. So once I finish writing it, then I go through a review. Strengths, weaknesses, what would you improve? And sometimes you read what it would improve. You go, yeah, but that's outside the scope of what I do. But still, it has to read everything and output everything. That was 21 prompts. Just to get an idea of tokens, because I can't actually find my token usage. I can only find percentage that I'm using. One token is about 3/4 of a word on average. And this is for GPT style models. So a 500-word prompt plus a 1,500 word output. Change the 500, divide by 0.75, you get 667 tokens in. 1,500 divided by 0.75 is 2,000 tokens out at these costs here. Would have cost about almost 11 cents for a prompt that had 500 in, 1,500 out. So if you give it a 10K, which might have 80,000 words, you can see you're somewhere around 110,000 tokens in. And if it's $10 for a million, having it read the 10K for you is going to cost you $1. So if you're going through 3 or 4 of these a day, you can see how your costs can really start to add up. Mine, not really, aren't adding up very much. Look at Gemini at the bottom. I pay $280 a month for it. Current usage, 0. Weekly limit, 0. I don't even use it. So I think I'm going to, of all the models, I'm probably going to eliminate that one. I'll probably keep Claude, but on the next screen, let me show you some interesting stuff there.
Oh, too bad, Claude. Well. But yeah. So I guess this whole token thing is going to catch on. People just don't want to pay these like flat fees for the like Gemini and whatever. I don't know. Does Google do tokens? I would think they would like start doing it, but it's a big thing for Anthropic and Claude, right? So I guess pay per token is way better. It's customized to how much you actually use the product. Rather than just having this flat fee. It's crazy, man. Google's charging like $280 for this. Like what kind of models do they have that are worth $280, right? You're gonna have to decide for yourself. I think this is where the problem stems from. You build all these data centers and you try to charge these people whatever it takes to subsidize, because you're losing money right now. None of them are going to be making money at the beginning. We already went to that website, which AI company makes money.com or something like that, and it shows like the only people making money are the semiconductor companies, right? The semiconductor companies are selling the pick and shovels to these people searching for gold with the AI models. And there's stiff competition with all the Chinese models running around and other people thinking like they could just start making smaller, low cost, cheap, efficient models and try to compete in that sense. So it's going to be a steep war of people, and all these guys making all these different models, well, they'll just increase the demand for semiconductors. Perhaps these people will destroy each other so badly that they'll wipe each other out and cause the crash anyway. Right? But the semiconductor companies can benefit in the short term, at least, because these guys are so greedy to try to dominate the market that they'll buy as many semiconductor chips as possible ahead of time to stock up to build their data centers to service their models. It's like, my model is better than the other guy's model. Well, show me the proof. There we are. We're entering that kind of world. Okay. So, I stopped at around 51 minutes, 30 seconds. Okay, I'll keep a tab on that. We'll revisit this some other time. And so let's get back to here a little bit. Let's look at how the market is doing on these futures. Okay. And let me see what other articles I got to get through. I got to get through some more articles. Oh, my God. Damn. Got to wrap this up. Okay, here we are. Okay. All right, let's get to this tweet here. All right, so if you haven't noticed or you haven't heard, Apple is suing OpenAI. All right, here's a statement they made to 9 to 5 Mac. At Apple, our teams are constantly developing breakthrough technologies to create the best products and services in the world. And protecting their work and intellectual property is something we take very seriously. Recently, significant evidence has emerged suggesting individuals employed by OpenAI wrongfully took Apple's secret and confidential information regarding our unreleased technologies, processes, and products. We will always defend our team's hard work and innovations, and we are taking all appropriate steps to do so. So they have been, I think Apple is contending that former employees of Apple that went over to OpenAI has been sharing secret sauce. Okay. Following that, OpenAI's director of strategic communications, Drew Pusateri, took to X to comment on the company's behalf. In his post, he claims OpenAI has no interest in other companies' trade secrets adding that OpenAI remains focused on building innovative technology that empowers people everywhere. Our statement in response to this suit: we have no interest in other companies' trade secrets. We remain focused on building innovative technology that empowers people everywhere. Okay, that's it. That's the tweet. That's the response. That's all we got. Well, we'll see. So this could be a big case that will take many years to get through the legal system, right? And we'll see how that will affect on the way out. But the wars are starting, the great wars. Everyone's trying to defeat each other. I think Elon has been siding with Apple, saying like, I told you so. Apple, I told you, Apple, that they were stealing your shit. Like, so it looks like Elon wants to go at OpenAI, and he's been kind of like turning around on Anthropic, saying like, oh, I was wrong. Anthropic is pretty good, actually. It's the top AI model out there. So Elon is giving his flowers to Anthropic. Seems to be that's the case. Okay, a little bit. Let's reverse a little bit. Go back towards the what's the bottoms, what are the tops, and last stream yesterday, or not yesterday. I didn't stream it. Two days ago on Friday, right? Friday night. I was talking about the VIX and the seasonality pattern. Okay, that someone wrote around here. What I did was use the cycle chart to highlight that. We have like a 130-day cycle on the VIX. So volatility increases into the late parts of the summer and the early, the late parts of winter as well. So the early part of winter is kind of like everyone's on the holiday, they're taking a break, they're not trading as much. The early part of summer is kind of like that end ride from the first set of earnings that comes out in spring. So that's why you kind of see this effect here. That's very stable. So 130-day cycle, when you have a 255-day trading day, is technically half a year, right? Half a year. So we have this expectation that volatility could increase into October. So that's why this guy tweeted that, and I responded with, yeah, this is common knowledge, I would think, that when you have a seasonality pattern, it's actually a very strong cyclical pattern that that is highly stable. So yeah, everybody's on watch for an increase in volatility after Friday hit a very good low in the VIX of 15. Okay, on that. Anything else I want to talk about? No, I think I'm done here. Yeah, I said it in a tweet right there, like this. Pretty clear that this is caused by less trading around the winter and summer months and the offset of earnings season. By the time the first week of August arrives, we'll have most of the top market cap stocks of the S&P 500 earnings, besides Oracle, Micron, Broadcom, Marvell, and Nvidia. So yeah, that makes sense. I think that makes sense. This should not be surprising. Okay. All right. Yeah, that's it. With that, what else I gotta go here? Any articles I need to wrap up? I'm behind on a lot of articles. Let's see. Peptide stuff. FDA. Any other tweets I got to cover? Anything important? I think I covered all the important stuff that I needed to tell you guys. Anything else I'll mention some other time. Yeah, okay. Let me just wrap up this stuff here. All right. Okay. I think I read this, but I don't remember. Okay, let me just get to it anyway. So I thought I read this, but maybe I didn't. Pretty sure I read something equivalent to this. Okay, let's get this done. Okay, Samsung record profit fails to impress after AI chip rally. I'm pretty sure I read this. So, okay. So this was on Monday. Yeah, all right. Late at night, so I probably read it on Tuesday, but I don't know. Well, all right. Let me just make sure that you remind you guys that Samsung quarterly profit surged 19-fold, but failed to impress investors used to eye-catching growth from suppliers of AI chips. So this is 18,000%. Well, 1,800%. I mean, my bad, 1,800%. The figures, while extraordinary on an absolute basis, aren't that much better than what the street was modeling for a stock sitting at the epicenter of the hottest sector in the whole market. Yeah, this sounds familiar. I probably did read it. So this is what we have to worry about, right? We have to worry about, like, when the earnings comes out, the expectations are so high already that if you just meet the expectations or barely beat the expectations, that might not be inducive of to attract people to buy more shares at these sky high prices, right? So that's what you got to worry about this week. This week we got ASML on Tuesday. Wednesday morning. My bad. Wednesday morning. Okay, that's what we got to worry about first, and then TSMC Thursday morning. Samsung reported record quarterly profit despite provisions to pay big bonuses for chip employees of as much as $400,000 this year. Very nice bonus that these employees get at their little factories in South Korea. A windfall that's escalating a national debate about what constitutes fair compensation. The sudden bonanza in AI-generated wealth reflects a growing shortage in memory chips that's become a critical bottleneck for AI development, and because manufacturers are giving priority to high-end memory development to meet data centers' needs, conventional memory prices are rising as well, endangering profits throughout the tech landscape. Analysts expect memory shortages to last through 2027 at least, giving Samsung and rival SK Hynix, which had IPO on NASDAQ on Friday, and Micron Technology, enormous pricing power. DRAM selling prices rose more than 40% in the April to June quarter from previous 3 months, while NAND prices jumped more than 50% according to HSBC. Demand is so strong that they are trying to ship more products to their server customers, which typically tends to carry higher margins, said Sanjeev Rana, head of research at CLSA Securities Korea, about Samsung's results. The company may be asking for significant price increases from big customers, he added. Samsung sets another profit record thanks to AI boom. This little graph here, you can see why the Korean market has been going up so well. Taiwanese market as well. Average operating profit margin for the three chip makers likely trended around 75 to 80% in the June quarter, according to market research firm Counterpoint. Such margins may raise concerns about excessive profiteering by memory makers and lead to regulatory pressure if the situation continues. Shares of Japan's Kioxia Holdings Corp, which competes with Samsung in NAND flash memory, fell as much as 12% in Tokyo, while chip gear suppliers such as Tokyo Electron and Screen Holdings Corporation also lost ground. I don't think the market adequately understands how good these numbers are, Counterpoint director Tom Kang said. Memory price increases were even steeper towards the end of the second quarter compared with the beginning. The boom will definitely continue in the coming quarters, so he's bullish. Samsung is slated to release full financial statements, including net income and divisional breakdowns, around the end of the month. So this was just a teaser. This is the weird thing about Samsung. They released like a preliminary set of earnings. So that was last week on Monday night. Then the real full earnings get released later on. So that's bizarre, right? So anyhow, that's it. That's all I gotta read there. Okay, good. Okay, so maybe I read it, maybe I didn't. It looks kind of familiar in the first paragraph, but maybe I didn't read it after all. Okay, let's read some peptide stuff. A little peptide stuff here. So this is from a pharmacist's point of view. All right, the peptide reclassification everyone's talking about. A pharmacist's take on what RFK Jr.'s announcement actually means. The Department of Health and Human Services indicated that BPC 157 and TB 500, Timothin Alpha 1 and CJC 1295, Ipamorelin, and others may return to Category 1, while Melanotan 2 and GHRP26LL37 and PEG MGF, oh my god, likely will remain restricted. Reclassification governs compounding legality only. It does not confer FDA approval, validate indications, standard dosing, or established benefit risk because phase 1 to 3 evidence and new drug application biologics license application reviews were absent. 2023 Category 2 actions were driven by concerns including immunogenicity, impurities, and limited clinical data, and they shifted demand from regulated compounding into unregulated research peptide channels. Operational resumption will lag announcements pending formal FDA list updates. Pharmacy Compounding Advisory Committee review timelines, raw material sourcing, and batch sterility validation. So assumptions of immediate availability are premature. Patient counseling should emphasize avoiding gray market sources. Okay, we already know that part of the things. Okay, here, let's get down to it. The policy direction is clear, but regulatory mechanics are still working their way through the system. If you spent any time on health-focused social media in the past few months, you've seen the headlines. Peptides are legal again. RFK has just unbanned BPC 157. The FDA reversed itself on 14 peptides. Patients have been bringing these headlines to my pharmacy counter almost daily. Some are excited, some are confused. A lot are asking whether they can finally get a prescription for the BPC. Okay, all right. So I think you kind of have heard that from Shkreli and all that. So go back to my other streams where I go over some other peptide articles and the Shkreli interview. I think that's very important for you to go back and look at it. All right, so continuing on, they were buying online from a research peptide website. Okay, that's the problem, right? The honest answer requires a bit more nuance than most of the headlines have offered. And as a pharmacist, I think patients deserve a clearer breakdown of what's actually happening, what hasn't happened yet, and what it means for anyone considering peptide therapy. What was announced? So February 27th, the U.S. Department of Health, Human Services Secretary RFK Jr. announced that approximately 14 of the 19 peptides currently on the FDA schedule Category 2 restricted compounding list would be moved to Category 1. The intent was to restore the legal pathway for licensed compounding pharmacies to prepare these peptides for patients, all right, with valid prescriptions. Valid prescriptions. All right, so that's where we're at. Peptides return. Okay, I think we already covered that in the summary. Several reports indicated that the substances would be removed from Category 2 effective April 23, and the FDA's Pharmacy Compounding Advisory Committee scheduled to formally review them is at July 23rd to 24th. Yeah, we already talked about that in another article. So what does reclassification actually means? This is the single most important point, and it's one I find myself explaining at the counter every week. A peptide moving from Category 2 to Category 1 is a regulatory designation governing whether licensed compounding pharmacies operating under Section 503A and 503B may legally prepare it. That's it. That's the whole change. It does not mean the FDA has approved these peptides as drugs. FDA drug approval requires a fundamentally different process. Formal phase 1 through phase 3 clinical trials, safety, efficacy review, labeling approval, and manufacturing validation under a new drug application and biologics license application. None of the 14 peptides under discussion have gone through this process for the indications patients are typically using them for. Category 1 status simply means the substance can be compounded under interim policy while the FDA continues to evaluate it. It does not establish proven safety, proven efficacy, or standardized dosing. The difference matters. A Category 1 compounded peptide is not equivalent to an FDA-approved medication. It's a prescription-only therapeutic that can be legally prepared by a licensed compounder under physician approval with no formal regulatory finding that it works for what it's being used for. Why the original restrictions happened. To understand why this matters, it helps to remember why these peptides were restricted in the first place. In late 2023, the FDA moved 19 widely used peptides to Category 2, citing concerns about immunogenicity, manufacturing impurities, and a lack of robust human clinical trial data. For most of these compounds, the available human evidence was thin to non-existent. BPC 157, for example, has extensive animal data, well over 100 preclinical studies, but only a handful of small human trials, none of which would meet the standard for drug approval. Yeah, we read that already. And Scully has pointed that out. The restriction effectively pulled these peptides out of legitimate pharmacy supply chains overnight. Clinics that had been prescribing them stopped. Compounding pharmacies that had been preparing them stopped. But this is the part that's frequently underappreciated, patient demand did not stop. Much of it migrated to a gray market of online vendors selling peptides as research use only, often with no quality oversight, no sterility validation, no standardized dosing, and no medical supervision. Whether you think the original restrictions were appropriate or overreach, and reasonable people disagree, the practical effect was clear. A regulated supply chain was replaced by an unregulated one. Where things stand now. As of this writing, the formal FDA reclassification has been announced, but the regulatory process is still in motion. Reports indicate that the affected substances were set to come off Category 2 in late April of 2026, with formal review by the FDA's Pharmacy Compounding Advisory Committee, PCAC, PCOC, scheduled for July 2026. 5 peptides have already been removed for Category 2 because the companies that originally nominated them for that list withdrew their nominations. In other words, the policy direction is clear, but the regulatory mechanics are still working their way through the system. Compounding pharmacies are unlikely to resume production at scale until formal FDA guidance is published, raw materials are sourced, and batch validation is complete. What patients should actually do. I've noticed a pattern at my pharmacy. Patients who've heard scary stories about peptides online are often looking for any regulated option because the alternative, unverified sources feel worse. A patient recently told me her family member had a bad outcome with an injectable medication and she was terrified to start anything similar. But that fear pushed her towards wanting a physician-supervised pharmacy compounded option rather than a gray market one. That shift from fear-driven avoidance to seeking proper medical oversight is exactly what the regulatory change is supposed to enable. But making these options legal to compound still requires the same fundamental step. Don't rush back to gray market sources. The temptation is real, and patients who used these peptides previously may be eager to resume. But peptides sold online as research use only remain unregulated and often unverified and frequently misrepresented. Anything sold without prescription is not the same as a prescription compounded peptide, regardless of how the label reads. Wait for formal FDA publication before assuming legality. A policy announcement on a podcast is not a rule change. Until the FDA formally updates its list and licensed compounding pharmacies are prepared to dispense, the legal status of these peptides for compounding hasn't changed. For patients considering peptide therapy, ensure they work with a qualified physician, not an influencer. Peptide protocols require medical evaluation, laboratory tests, and ongoing monitoring. Social media is full of dosing advice from people without clinical training, and many of the protocols circulating online are not evidence informed. Ask about sourcing. Not all compounding pharmacies are equivalent. The ones worth using carry PCAC accreditation, comply with USP 795 and 797 standards, can provide certificates of analysis, and source raw materials from third-party purity verification. If a provider can't or won't tell patients where their peptides are coming from, that's a red flag. Understand the evidence picture, not just the legal picture. The legal landscape is shifting, but the underlying clinical evidence for most of these compounds hasn't changed. BPC 157 still has the same handful of small human studies. TB 500 still has no completed human randomized controlled trials. Reclassification doesn't validate efficacy. It only restores a regulated pathway for access. All right, there you go. Stay safe, guys. I gave you the warning, right? So how does this affect like something like hymns? I wonder. So I'm gonna have to go through hymns a little bit more in detail and see how exactly they plan to give people peptides that they can trust, right? That would be the game plan if they're preparing themselves for when these peptides are finally be made with the sourcing, right? That's the problem you see here. They're sourcing something and it's broken now because those sources that were legitimate won't make these peptides for you until the FDA changes everything again. All right, this July. All right, White House reviewing top contenders to lead the FDA. So this is the problem we have now too. There's nobody leading the FDA. The guy got fired. The guy got fired some months ago. The top contender to lead the Food and Drug Administration have been sent to the White House for final review and decision. According to a person familiar with the process, the finalists include Heidi Overton, a White House advisor, Jeffrey Vakira, an oncologist and health system executive, and Stephen Verrera, a health affairs official at the Department of Defense. All three did not immediately respond to Stat's request for comment. The advancement of the finalists suggests the highly anticipated decision is on the horizon, though the timing remains unclear, so we still don't know what the schedule is. The movement comes as drug and device makers eagerly await the next leader and direction of the agency. So this will really affect how these biotechs and the healthcare sector will move, right? So you're in no rush to get into any of these stocks right now if we don't even know who or when they're going to decide this. All right, so blah blah blah. Marty Markary. So that was the last guy. The agency's first leader in Trump's second term resigned in May after frustration from administration's leaders. During his tenure, he saw dire morale at the agency and a series of high-profile flip-flops on policies and personnel. Kyle Diamantis, the FDA's top food official, is leading the agency on an acting basis. Industry leaders grew fearful that the agency couldn't be trusted to make decisions based on science alone, leading to new lobbying pushes at the highest levels of the administration to influence outcomes. The finalists to take the job, first reported by Bloomberg, are being considered in conjunction with other people who could potentially work with them to lead the FDA, the person said. The team-based approach would ensure the next commissioner has a balanced team surrounding them. The next leader will not only need the president's approval, the Senate's health panel will have to confirm them. That committee is led by Senator Bill Cassidy, Republican of Louisiana, who has faced Trump's ire over disagreement with the administration policies and recently lost his primary campaign to a Trump-backed challenger. All three finalists are medical doctors, and two are currently in the administration. Overton was previously part of the America First Policy Institute and has ties to Makary, co-authoring a paper on opioid overprescribing with the former commissioner. Ferreira, the principal deputy assistant secretary of war for health services, previously worked in the Navy Bureau of Medicine and Surgery and as the CIA's chief medical officer. Vakirka is CEO and chairman of the board of New York Cancer and Blood Specialists and has previously supported GOP leaders. So those are your choices right there. Okay, done with that. Anything else? Let me play some videos here. So I'm done with talking and babbling and reading you these articles. Okay, we're finished here. Let me look at the charts for a while. Let me play some small videos for you. Let me see what these charts have. I just got a little bit more time, right? We already have 2 hours. Okay, a little bit more time. That's good. Finished off most of this. Okay, we got earnings. So let's see. We're at the bottom here of the range for Intel, right? Okay, down 2% overnight market as the market is digesting the Trump war with Iran. It might be coming back again. Ooh, wow. So you can see like UK oil, US oil is up. See, UK oil, Brent oil is up 5%. So that's the international oil market. WTI oil, I guess US oil, is that where? Okay, yeah, US oil crude is up 4.2%. So that's where we're at. Let's look at the NASDAQ futures here. We're down. So we were down 0.3%. Now we're down 1%. So let's see how that goes overnight. All right. I think Korea has been pushing everybody down. So let's look at the S&P 500 futures. Let's see if that's down 0.5% based off of that. Let's see. Yeah, 0.5. I was right. Yeah. So NASDAQ, hasn't been dragging the S&P too far away from its little 7,500 mark. I think it likes to stay at 7,500 until we get some earnings. And let's look at what else? Let's look at gold. How's gold doing? Okay, gold's down a bit, huh? 1%. Okay. Gotta see if we can get through this. We haven't really been going anywhere with gold. Gold and silver have been stuck here. So I think you're gonna have a better time to buy gold and silver some other time. It's not worth it, I think, to try to get this. I think it will go down. Like silver's down 2.4%. Yeah, I think we will move down to the next level in silver and gold fairly shortly. We have a very small window where gold and silver can go up before the cycle, say, would go back down. And probably the same thing with Bitcoin. If Bitcoin does not make its move very, very soon, like, okay, like this thing has to get to like 80K in the coming 2 weeks. If it can't do that, see you back at 60K and below. That's where we're gonna go. Probably that will be a nice bottom for you to look for a buy, right? So if any of you guys want to be starting to buy, you could start when it starts making a new bottom at 40K to 30K into December probably, and it might not even go back up until April next year, 2027. So you can be patient. I don't think there's a rush really. Anything else to look at? No, I think silver's gold. Yeah, that's it. USD, JP Morgan. I mean, not JP Morgan. Yen. See how that one's going. I mean, we're still up here at 162. I don't think the Japanese can do anything. It's still too high. Yeah, I haven't seen anything here yet. And we're still in bubble territory, So the core 3M, so the dispersion is very high. We're still moving up. So yeah, stay careful. Anybody could probably break the market on these earnings. But maybe it won't happen until August. All right, we're done with that. Okay, let's go. Let's watch the video here. Let me see. Let me show you. So I mentioned the dispersion. Let me go to this video and show you what I mean. Okay.
We just got the lowest closing print on the Core 3M, which is
there we are.
A tool or an index that measures how correlated the market expects the S&P 500 stocks to kind of be with each other over the next 3 months. And there's a very interesting pattern that I've noticed here. So I'm going to go ahead and bring that up on today's stock market report. This is where we do videos Monday.
All right, so let me skip ahead to that. So we're gonna be looking at that. Right, here we are. We're gonna talk about it in detail here.
To be a great setup, and it'd be probably the perfect opportunity for a big bull trap, but hopefully that's not going to be the case. Hopefully we're to just see some blue skies again after, we've been consolidating for a couple of months now. Now here's the S&P 500 up top. This is DSPX. This is the dispersion index. We're just dividing it into core 3.
That's what I just showed you.
And it just printed another new high print, all-time high print. So we haven't been in this territory. And you can see the DSPX is creeping up here. And I wanted to kind of dive into Core 3M over here. And once again, Core 3M measures how correlated the market expects the S&P 500 stocks to be with each other over the next 3 months. And a high reading, kind of everything is moving in lockstep, right? It's like this macro-driven index tape sort of thing. Low is when stocks are kind of decoupling from one another, and that's that more stock pickers type environment. And we just got our lowest printed reading, at least in the history set that I have, ever. And what I found interesting here was it's coming in, obviously, the month is...
And we've seen that, right? Software doesn't really follow together clearly, right? Cybersecurity is separated from everybody else at the most part. We got like Palo Alto Networks has been going up very well, and then we have losers like Oracle or Adobe or Microsoft that don't follow that. We've seen it with like semiconductors don't follow like the biotechs, right? That stopped working for a while as well. They're all part of tech. They should all follow together, but they don't. So yeah, since May going on into June and then now July, it's gotten worse and worse. We get less correlation. If you pick the right stocks, then you'll go up. If you pick the wrong ones, then they'll go down. Like you picked space stocks, right? 2 weeks ago when SpaceX came out. Those have been going down, down, down. And now it's like just stuck at the bottom where it was like from the beginning of the SpaceX drop. That's been going nowhere. It might break down and then like maybe somebody else will take over and go up, right? So they don't follow at all.
July, right? We came from June to July, and I just noticed, I'm like, oh, what? Many times actually we see in every June and July, mainly July, we see it actually start to head down from a prior spike. So you can see over here, June, July, you see over here, June, July, over here, you see June, July. I don't know what this did. Oh yeah, June, and then July was also kind of a little bit lower there too. And that's all I have right there, but you can see that's pretty interesting. And now another reason I want to point this out is because the Core 3M, it's also pretty correlated to the VIX, right? If you overlay the VIX, which is the volatility index of the S&P 500, as we're cracking to new lows in a period where we typically see sometimes lows in the Core 3M over here, you can see that these are very measured up. So the reason I'm calling this out is because if Core 3M is about to start to turn up, there's been cases where the Core 3M turns up right kind of at the same time, and sometimes even before, giving us indication that we may be seeing increased volatility in the near term in these markets. And then when I pulled up seasonality to look at July, take a look. You get this big move down in July, right? This called summer trade, and then towards the end of July, you get some sort of a spike in volatility. Are we setting up for something similar to that? Perhaps. I think we need to be open for that idea. That's why this could be a potentially really good look for the bears, is if this turns into a big bull trap, but we are still in that bull strong environment. So for me, when I see this, I'm still adding exposure into the market. And the moment that all of a sudden we cross under wherever the gamma flip line is at the time, and we're back below a 10-day moving average, or it starts to flatten out and we come down, I'm going to be very, very quick to adjust the positions that I put on. They're going to get stopped out, and I'm going to go ahead and move on with my day until conditions obviously get better. That's
all right. So that's his game plan. I don't know what your game plan is. If you made quite a bit of money already this year in your long positions, be careful, right? Be careful. We are at kind of strange conditions where it could easily snap back, where all the stocks start going down together. Right now we've been safe. Like people have been moving from one little place to another little place to hang out, and that's kept the S&P 500 going very much sideways in a low volatility manner. Okay, very quiet, but that could just be like the calm before the real storm. So don't be surprised if all of a sudden something out there, earnings or some Japanese yen problem, or who knows, Iran war starts kicking back up and everything just goes whoop, and just flips back down. So yeah, be careful, set your stops, and probably you're going to have to tighten them up starting this week. Okay, that's it. That's my warning for you. Okay, and we'll go from there. Now, I want to talk about a little bit about the dark pools, but I'm going to get to that probably next time tomorrow. But let me preview that for you here. So dark pool. Okay, why am I going to talk about the dark pool? What is the dark pool? What is the dark pool? Yeah, I mentioned this several times before, but very briefly. Nothing major. Nothing major. So before we get to the dark pools, though, this is the last graph I want to show you. This is, well, let me see if there was an explainer that went with this. My bad. I have an explainer here. Some guy asked Grok for an explanation of this, so I might as well just read it since it did the work for me. I don't want to explain it from my own lack of knowledge. All right, the graph shows a spread between average S&P 500 stock 1 month 25 delta call implied volatility minus the XPX index implied volatility. Now, what the heck does that mean? I don't know. I'm sorry. I'm not an options guy expert here. Okay, I don't know why you have to care about the 1 month 25 delta call implied volatility. It's now at a record plus 32 volatility points circled. So that's what's circled up here. So it's higher than the 2008 and the 2020 to 2021 over here, and it's higher than the yen carry trade up here in 2024. I'm guessing that's why it's high up here. Okay. Let's see. Single stocks are priced for far higher volatility than the broad index. That's what was said in that video and what I've said before. A sign of extreme dispersion. Index volatility stays suppressed by mega cap concentration, while individual names carry big risk premiums. Classic market getting crazier chart. So it's the most zero-sum game component amplification? That's what this dude asked. Yes, spot on. Mega cap concentration keeps the index volatility artificially suppressed through averaging and lower effective correlation. Single stocks embed much higher premiums for idiosyncratic risks and potential sharp moves. This widened the spread dramatically, turning component level options into a higher stakes, more dispersed, less correlated arena. Classic amplification of dispersion in a concentrated market. Okay, thanks, Grok. That's a very long-winded way to talk about this. Well, in any case, all you got to know is that the market condition is ripe for a crash. That's all this means. So we're ready to start crashing, right? As this thing starts moving up, once you hit a crash, this thing just like goes, boop, returns back down. So we are at the highest we've ever been, I guess, in the whole history of the S&P 500, all the way to just before the Great Financial Crisis. So there you are. Does it mean we'll crash this week, next month, 1 year from now? That's what it can't tell you, right? We can't tell you that. But whatever crash that is coming, expect a big one to appear, and that will give you a good opportunity to buy the dip. All right. So it will be at least something that looks scary. Okay. It looks like it's about to be the big pop, but it's not really the pop. It's just the big drop before the bigger pump. And that's what happened during the .com era. Because the .com era, you have to remember, there were many times where people thought the bubble popped, like in 1996, 1997, up to 1998. And that was just a prelude for the big run-up in 1999 to 2000. So we could just be like at the beginning of the first big scare, right? We've had like some big scares. I guess a tariff, you might consider that's a scare, or the Iran war is kind of like a scare. But I'm thinking there's going to be something that looks so deliciously bearish that people think like we're going to get into a bear market right now, and that's a trap. That'll be the real trap for the bears to get overconfident that the market is starting to fall down another 30, 40, 50%. All right, so for the first time in history, the majority of U.S. stock trading occurs off exchange. This would include dark pools. So here's your preview. We're going to start talking about dark pools a little bit next time I meet up with you guys tomorrow. So we're going to have to discuss this a little bit more. I don't have a lot of knowledge in dark pools, but I've noticed that people have built these websites to track it better than when I started paying attention to them. So off-exchange volume is exploding in the stock market. This is also another reason why I don't know if the volume data you get is useful. Okay, if they start trading more in the dark pools, you can't tell if like the volume data that you get for free is really the true activity of the markets, right? And that affects how you use Wyckoff. So if you have to use Wyckoff strategy to determine when you buy and when you sell, you need volume data. And if the volume data is disappearing into the dark pool and you don't see it on your chart, you're going to make mistakes, right? And that's what you don't like. So off-exchange volume, right, is now about 50% and above in 2025. So I don't know what the updated chart is. This is the only chart I got. This guy tweeted it in July of 2026. What's the update? Can you give me like what does it look like here? I'm guessing this is very old, crusty data that they just averaged out and gave to us in this plot. But luckily we have this. We have this website here. I found it. I just Googled it and I said like, well, give me some free dark pool websites. And I got this one here that says darkpoolheatmap.com. And you could pay to get better information or data, but this is the free stuff that you can see right now without signing up with them. Maybe this is useful. Maybe I'll try and see if I can incorporate this. But it's showing that we have unusual dark pool activity in materials. So does that mean I should be buying uranium, gold miners, silver miners, lithium right now? Is that why we're seeing this? We also have unusual activity in XLK, the technology. Well, that's duh. I mean, XLK would always be popular, whether it's dark pool or not dark pool, right? So, of course, that's going to happen. The other one is like financials we see here. So people are buying up banks or selling banks before the earnings. We got big earnings for the 4 major banks on Tuesday. So maybe that's why this is occurring right here. But overall, what I learned about dark pools was very simplistic. And I'm going to show you this to tell you what I know, which is very tiny and very useless, I think. So let me get you something back here. Let me get you something back here. Let me get you something. So I got this. Okay, I got this, and I got this. Why am I showing you these tables? What does this mean? Okay, and let me get you the SPX here. Get you the SPX here. Let me get rid of this. Okay, I'm going to just do this. Okay, all right, I got this. Okay. All right. So this table here shows you 2025 February. Okay, let me see. This one was March 2025 and this was 25. Okay, so this is all in 2025. All right, if you remember, this was before the tariff stuff happened, right? This is all before the tariff stuff happened. Okay, if you want to look at the dark pool, yeah, you can open up the CBOE website and you can look at the market statistics. Okay, so equities market volume summary, and this is how you would look at for the dark pools. You would go down here to FINRA and TRF volume. So that's the dark pool volume right here. This is the volume that you don't see in the NASDAQ, the NYSE, and the CBOE. So the futures market, the NASDAQ market, and the New York Stock Exchange market. These are the primary markets, right? So CBOE has the futures, the options. NASDAQ has the stocks on the NASDAQ, and the New York Stock Exchange has the stocks elsewhere, everywhere else. Now, the TRF data, the FINRA data over here is where people hide, I guess, if you want to say they're hiding things from the public. And if you look at the percentage up here, today So this was back in February 13th, 2025. It's 51.24%. Okay, so remember that number, 51.24%. Usually you would get about like a 50% in the dark pool. So half the time you get 50%, which is what that chart over here showed you, right? This is what it's been showing you, 50%. So that's where they got this data. All right, so we're already there. That's the normality of things. We are at 50% hidden volume. All the volume, half of it is hidden. Now, why did this February date? Because that was just before like the crash. Share the screen of the chart so that you can remember how things are. Okay, so all right, so you're looking at that. So this is 2025. Okay, so let me zoom in here. So look at the dates around the top. Now, sometime about February, okay, we got February 13th all the way through February 21st. This is where the top was, okay? We know this is the top because we have 2020 hindsight. I can look back in time and tell you what top is. Can this use to tell you the future? Okay, you have to look at is during March. So around March 3rd, you see this like down, up, down type action here. This is where it's like, oh my God, this sucks. Everything is going down. Well, this is the second chance you had to get out before it went down lower. So this area here around like March 3rd, okay, that's another point to look at. So look at the first dates, right? Between February 13th to February 28th. That was like where we are at the top. So 13th to around 28th, around here. So this is the last big green bar on that day to like the next red bars going down here to 27, 28th, the green bar, 28th. All right. So we're going to look around these dates, right? This date and these dates over here. That's what I'm looking for. That's what I'm looking for to see if I can use dark pools to find a signal. All right. Hopefully you kind of get what I'm saying there. With that, so I'm gonna take this away. Bye. Okay, let's go back here now. So here's the 13th. You see 51.24%. Now what happens in the 28th? 2 weeks later. Oh, look at that, 48.89%. Usually the dark pools don't change that much from day to day. Okay. So after like a couple weeks, we see like the dark pools are starting to change. Less people are using dark pools and they're more using the light. So they're going into the market that's out in the open, in the light. They're not going to the dark. What does that mean? So someone told me this a while ago, like some years ago, that one way to detect like the market is going to have a nasty crash is when the dark pool suddenly shrinks because people are in a hurry to get out of their positions. Okay, the people can't get out of their positions in one day. Like the very rich people, like if they want to really get the hell out of there quickly, they need to go to the open market because the dark pool doesn't have that much volume when you have an emergency. So if they're prepared to get out as quickly as possible, they're not even bothering to hide it anymore. They're trying to get out as quickly as they can in the open market during the open hours or the closing hours of the normal market, right? And so you're going to see this happen where the dark pool suddenly shrinks. So the 5-day average was 50.61%. And 2 weeks ago, it was at 51.24%, very stable. And the five-day average was 51.29%. But suddenly now the average is dropping. And then that day, on the 28th, when we have that big red bar, we were like 48.89%. So that tells me that they were panicking. They wanted to get out of the market before the next big drop. So that's a clue. Okay, that's the dark market, the dark pool market data to determine if like there's going to be some serious problems ahead. Okay, so I give you a little tip right there to try to time the market that way. So that's one way to do it, is with dark pools. Now the next couple days, right? The next day, I think this was a Monday. You see, now it's dropped to 47.94%. So even though there's a green bar and then another red bar, another green bar, they're using less and less dark pool. That means they're selling. They want to get out of there before the next move down. So the next time Trump opens his fat mouth, they're already gone. They know it's bad. So that's another way to do it, is through the dark pool. And now that we got these websites that can do this, maybe we can do a lot better than that, because that was the only thing I used the dark pools for. I was just using it to just say, like, okay, maybe from time to time I'll check like the dark pool data to see if there's something that I feel is fishy and might come up. But with these websites that these guys programmed that can get a lot more information, and even like they can go down from sector to sector and look at the dark pool, maybe, we could incorporate this into the AI and go like, well, I see the chart improving in banks. I see the chart improving in healthcare. Like, looking at the dark pool, does it confirm or not confirm that information? So yeah, it's very good. We got a lot of nice things for us with the high-tech markets here. Okay, guys, I'm done. I gave you a preview of what we want to figure out, maybe tomorrow, maybe sometime down the week when I have time to look over this dark pool type of information, because I feel like this is another thing we could add on to our toolkit to improve the timing, not only to time the big market, but also to time the sectors and maybe even the stocks themselves. All right.